Hello guys, Hamish Patel here from mortgagesonline.co.nz. Just wanted to touch base on, well, to have a chat about some of the figures that have come out, and also a little bit of a talk about what to expect next, really, for next year. So we've had a pretty busy Christmas. I think a lot of people in the industry are noticing a little bit more busyness, but it's been a fairly patchy year, so it's up and down it's been up and down all the time. So hard to say whether that's an indication of a busy start to Jan. If we look at the RENZ stats that have recently come out, Auckland is basically fairly flat, as we know. Outside of Auckland, though, still pretty buoyant. So New Zealand, excluding Auckland, median change is about 8.4% compared to November 2016, whereas 0.6% in Auckland. So yeah, I wonder if that's an indication of investors chasing yields or better cash flow properties. Hawke's Bay showing a 19% increase, so fairly substantial numbers. What's driving these changes? That still hasn't changed. The story's still the same. Net migration has been huge. This is the last 10 years. If we look at the line, if we look down the middle here, this is the 5-year mark, right? So, we've been adding 60, 70,000 people a year for the last 5 years, really. And, before that, it was pretty flat. Now, are we building enough houses to cope with that? And I think that's where the big pressure is from. No, we're not really, because if we look at this figure here, this is the building consents. This is, again, the halfway line here. This is around 2009, right? And this is now. We are building as many houses as we did at the peak in 2004, and it has been ramping up fairly slowly over the last 7 years. So yeah, it's probably supply is not really coming on stream as quickly as anybody would like. The government, I know, is talking about building a lot of houses, and I wonder if that will be at the expense of the private sector, because it is hard to find the builders and electricians, plumbers. Everyone's fairly busy in Auckland right now. So I wonder how they'll be able to ramp up and get 5,000 houses built a year when our total is somewhere around 20,000 to 20 to 30, 25,000 houses if we're lucky per year. So I don't know how quickly that will come on stream. The real story for house prices has really been a story about the central banks all over the world, really, and what kind of money they've been creating. And I think that if we look at some of the stats out of the US Federal Reserve, their balance sheet has quadrupled in the last 10 years, around 9 years, it's quadrupled. So a huge increase from $1 trillion to $4.5 trillion sitting on their balance sheet. So yeah, it's been some big increases there. So I think I still think there's a lot of drivers in the housing market that should mean a pretty busy January and February at least, and outside of that, it's going to get pretty interesting. I think there's a few things coming out that the government's putting out which seem pretty understandable, really, like the Healthy Homes Bill. You got to have a drier, warmer home going forward. And I think most investors that I have anyway, when they pick up a house, they usually do a little bit of a tidy up before they rent it out. And I think that the tidy up bill will probably be a little bit extra. It might be like $3,000 to $5,000 per property at the start. So to get it up to standards for some properties you won't have to do anything, of course, when you're looking at newer homes, I think. So yeah, that's on the horizon, but I don't think that's that scary. Negative gearing is going to disappear. I think that's going to mean maybe investors look more at the cash flow, look at better yielding properties next year. But it's not the end of the world if you're a long-term property holder, really, because your negative gearing disappears. So you can't offset the actual losses that you had that year against your PAYE, but you can carry the losses forward for some clients sitting with better cash flows and stuff. They probably won't mind. And really, I think the big effect will be if you bought your house in the last 3 to 4 years, because before that, the rents have probably gone up if you bought that before that, and you probably bought at a much lower price. So the other couple of things on the horizon, I think will actually cause a little bit more busyness in the market, like the bright line tax is going to be, there's going to be a bright line tax in over 5 years instead of the 2 years at the moment, and then possibly if the Labour get in, The next time round, we'll have a capital gains tax most likely, but we'll find out whether they intend to do that within the next 3 years. So I think what that will do is probably, it'll slowly sink in that if you're going to buy a property, it's a good time to buy it in the next 3 years, as that property that you're buying will be exempt from any capital gains tax in the future. So I think there will be a little bit more of a rush to get in before those windows close out, But but all in all, I think it's going to be a pretty interesting year. Really, it's still busy. It's been a pretty busy Christmas for us, actually. A lot more people showing interest in trying to get into the market. The Reserve Bank is kind of easing up a little bit on the rules, so that should be interesting as well in January. So 1st of Jan, you see a lot more first home buyers coming into the market, and maybe a few more investors in much cheaper properties, because the deposit levels have gone from 40% to 35%. But hey, look, thank you for listening, and hopefully that's been insightful. Remember us for your next home loan or refix.